Oracle missing estimates on the top and bottom line for the third quarter. The company did also lift its quarterly cash dividend to 50 cents a share. Here with more on the quarter, let's get to D.A. Davidson Managing Director Gil Luria. So Gil here, interesting sort of a mixed picture, I guess, if you will, because the miss, but then a little bit of carrot here offering that dividend. What do you make of it?
Yeah, it's a balance between the business Oracle is currently in, which just missed the low end of guidance, and the business they are moving into, and they are guiding very aggressively into the next fiscal year. They guided to 15% growth next fiscal year. Expectations for them were still single digits heading into the quarter. So that's the good news. That's the ambitious part. The not as good news is they couldn't even meet the low end of their guidance range for this period, for the period that just ended in February, and so we'd have to evaluate based on this call, how realistic is it that they can get to 15% revenue growth, and at what margins is that going to come in? Because their current business is a very profitable business. The business moving into, which is, I'd call it surplus GPU rental, is not as high a margin of business.
Gil, when you think about the big, great cloud competition out there, and you think of the big three, Amazon, Microsoft, Alphabet, how does Larry Ellison's company now stack up there?
So the good news is that Oracle Cloud is built on the new infrastructure, meaning they've only have the NVIDIA GPUs and Mellanox networking equipment. They don't have legacy hardware that the big hyperscalers have, which is what's allowed them to become a share gainer, even if from a very, very small base. Now, going forward, the big expansion of their business is the GPU rental business that's grown very fast for the hyperscalers, but is growing even faster for Oracle Cloud. And part of the reason is that they're really the overflow provider. They even have a deal with Microsoft that's giving them some of their volumes because Microsoft hasn't built out data centers fast enough, so they're shifting some of their volumes to Oracle, which is why the RPO number grew so fast in the quarter, because they're signing these long-term deals, among others, with the hyperscalers that can't handle all the demand themselves right now.
Gil, this is one of these moments when I'm going to ask for a pause. RPO, remaining performance obligations. For those who are watching who don't follow the lingo and Oracle like you do, what's the significance of that to the company?
So that's the value of all the contracts that they've signed going forward. So they haven't recognized yet. So that's not revenue that they've already recognized. That's revenue that's coming. And so when they say that they have $130 billion in that means that that's revenue that's contracted, that they will be recognizing over the next few years. And it gives them some visibility, gives us visibility that they can grow from here, because that's far greater than the revenue they've been recognizing.
Gil, you got a neutral on Larry Ellison's company. How come, and what would it take to get you more bullish?
Well, the neutral has to do with the fact that we keep talking about OCI, which is less than 20% of their revenue. About 60% of Oracle's business is a declining business. So they really do have to grow OCI very, very fast in order to make up for the fact that their core business, most of what they sell, Oracle databases and ERP systems, is a declining business. And then on that very fast growing part, when I say that they're overflow, I don't mean that as a good thing. Once Microsoft, Amazon, and Google have enough capacity that they can handle all the demand, which could be even later this year, there's not going to be as much overflow. There's not going to be as much room for that fourth player, and especially there won't be that direct demand from Microsoft into Oracle. So next year they have a path to grow faster, but I'm not sure it's the kind of growth that you want to get if it's spillover from your bigger competitors, especially if it's coming at much lower margins than your core business is at today.